Imagine you buy a 2-buy leveraged ETF tracking an airline stock, like American Airlines, and you decide to hold it for exactly 1 year. Over those 12 months, the airline's stock price bounces through turbulent news cycles, but by the end of the year, it lands exactly where it started, a 0% total return. Logic suggests your leveraged ETF should also be flat. 2 times 0 is 0. But checking your account, your portfolio is down 22. To see how this works, we can look at a 48-hour simulation. We start with a baseline stock priced at $100 on the left and a $100 investment in its 2x ETF counterpart on the right. On day 1, the stock gains 10%, rising to $110. The ETF perfectly doubles that gain, jumping 20% to land at $120. On day 2, the stock drops 9.09%. That percentage takes it right back to the $100 starting line, resulting in a 0% total return. The ETF doubles that daily loss, dropping 18.18%. But because the leverage reset at the end of day 1, that drop is applied to the new, larger base of $120. That strips away $21.82, leaving the ETF at $98.18. This reveals the core mechanics of asymmetric base sizes. Equal percentage swings in price are not equal in dollars when the base size changes every 24 hours. To maintain that 2x leverage ratio on a changing base, fund managers must continuously buy more exposure after a gain and cut exposure after a loss. Running this algorithm of buying high and selling low creates a mechanical friction. Across hundreds of trading days, it drags on the portfolio's value. This is volatility decay. While the base stock bounces sideways over a year, the 2x ETF traces those same jagged moves but steadily drifts downward, acting as an invisible tax in choppy markets. In a smooth one-way upward trend, this same compounding math can actually push returns higher than a simple 2x multiple. Because the math is so aggressive, these funds include an airbag mechanism. If the underlying stock drops 25% in a single day, trading halts to rebalance the portfolio, preventing a 2x leveraged fund from hitting 0. Leveraged ETFs operate as highly calibrated mechanical engines that amplify both market trends and structural friction. Traditional stock investments and daily leveraged ETFs serve different masters and require different strategies. Traditional stocks are destination bets. Investors generally focus on the final price on the day they decide to sell. Holding a daily leveraged ETF for longer than a single day turns the investment into a high-stakes bet on the specific sequence of daily events, a concept known as path dependency. The ideal market path for these funds is smooth and cleanly trending. The dangerous path is volatile and jagged. When held through turbulent sideways paths, the math of daily rebalancing generates a persistent drag on the value of the holding. Leveraged ETFs are tactical tools designed for single-day precision. Applying them to long-term wealth accumulation miscalculates the specific mechanics of the math.